Chapter 10, Stockholders' Equity. As a reminder, the accounting equation, assets equals liability plus stockholders' equity. In this chapter, we're going to look more in depth into the stockholders' equity section of the accounting equation. The stockholders' equity section is made up of three primary components. The first is paid-in capital, also known as invested capital. It's the amount of money that stockholders have invested into the corporation. This would be like your common stock. Retained earnings is the second component. Remember, retained earnings is the amount of earnings the company has kept, or thus retained, since inception. Earnings that have not been distributed as dividends to stockholders over the life of the company. The third component is treasury stock. Treasury stock is a company's own issued stock that has been repurchased. It's important to note that own stock. It's not an investment in another company. It is when one company buys back its own stock from shareholders, and we'll look more in depth into that later. So part A of this chapter, we discuss transactions involving the paid-in capital, also known as invested capital. Identify the advantages and disadvantages of the corporate form of ownership. Remember, a corporation is an entity that is legally separate from its owners and even pays its own income taxes. Corporations are formed in accordance with the laws of individual states in which it is incorporated in. So it's different depending on the state in which the corporation incorporates. The state incorporation laws guide corporations as they write what's called the Articles of Incorporation. The articles describe the nature of the firm's business activities, the shares of stock to be issued, and the initial board of directors. The board of directors is responsible for establishing corporate policies and appointing officers who manage the day-to-day corporation. Ultimately, as you see in this chart, a corporation's stockholders control the company. They are the true owners of the corporation. By voting with their shares, stockholders determine the makeup of the board of directors, which in turn appoints management to run the company. So the CEO is the one that has been hired by the board of directors to run the day-to-day company. The CEO is responsible for vice presidents, CFOs, legal counsel, things like that. The board of directors appoints the CEO, and ultimately the stockholders elect the board of directors. So the stockholders are the ones that are in charge of and true owners of the corporation. Most corporations first raise funds by selling stock to the founders of the business and to those friends and family. As equity financing needs of the corporation grow, companies prepare a business plan and seek outside management from angel investors and venture capital firms. Angel investors are wealthy individuals in the business community, like those seen on Shark Tank, willing to risk investment funds on a promising business venture. Individual angel investors may invest from a few $1,000s to millions of dollars into this new corporation. A venture capital firm provides even additional financing, often in the millions, for a percentage ownership in the company. Many venture capital firms look to invest in promising companies to which they can add value through business contacts, financial expertise, or marketing channels. Most corporations do not consider going public and issuing stock to the general public until the equity financing exceeds $20 million. The first time a corporation issues stock to the public is called an initial public offering, an IPO. So here's a way to look at it, thinking about it as a tree. When a company is first formed, a little baby tree is planted and the investment is put in by the founders of the business. Then, in order to grow the tree, they seek investment from friends and family, and the tree gets a little bit larger. Then, as the needs grow, outside angel investors and venture capital firms put in money and lend expertise to help grow the tree. Then, the tree is a fully blossomed tree, and an initial public offering is made so that there can be public outside ownership within the company. Now, just because a corporation has stock does not mean that it is a public corporation. Corporations can be public or private. The public corporations allow for public investment, whereas private there is not. Corporations that are public trade on the New York Stock Exchange and on the NASDAQ, or by over-the-counter trading. This allows for more stockholders to invest in the company, whereas with a private corporation, you normally have fewer stockholders. Many times it's close family and friends only invested into a private corporation. Public corporations are regulated by the Securities and Exchange Commission, the SEC, and it results in significant additional reporting and filing requirements. A privately held corporation is not required to file financial statements with the SEC. Examples of public companies include large companies such as Walmart, Microsoft, and Intel. But examples of private companies can also sometimes be large companies. For example, Cargill, which is an agricultural commodities company, Koch Industries, which is oil and gas, and Mars Company, which is food and candy. Those are large companies that are still privately held and not traded on the public stock exchange. Frequently, companies begin as smaller, privately held corporations. Then, as success broadens opportunities for expansion, corporation goes public. For example, Facebook was a private corporation until it went public in May 2012 and raised $16 billion of outside funds. Similarly, Alibaba, a Chinese online commerce company similar to eBay in the United States, went public in September 2014 and raised $25 billion of outside investment funds. That was the largest technology IPO ever made. Whether public or private, stockholders are the owners of the corporation and have certain rights. They have the right to vote, including electing the board of directors. They have the right to receive dividends when a company declares dividends. The amount of dividends that they receive is determined on the number of shares that they own. They also have the right to the distribution of assets if the company is dissolved. Again, they would be entitled to their share after creditors and after preferred stockholders are paid. We've talked about the advantages and the disadvantages of corporations way back in chapter 1, but I want to review them here with you. Corporation offers two primary advantages over sole proprietorship or partnership. The first is limited liability. Limited liability guarantees that the stockholders in a corporation cannot lose more money than they have invested in the company, even in the event of a bankruptcy. So, for example, I think I talked about this back in chapter 1. My uncle has a boat repair business. He had previously not been incorporated and was acting as a sole proprietor. So the debts that he incurred in his business and everything were his personal liabilities. So if the company was to go under, the debtors could come after his house, his car, his boat, his bank accounts, anything that he has, because he didn't have that separation of a legal corporate entity. He is now incorporated and has that limited liability. So that if something were to happen and the business goes under, they can only come after the assets of the company. The second advantage is the ability to raise capital and transfer ownerships. Because corporations sell ownership interests in the form of shares of stock, ownership rights are easily transferred. An investor can sell his or her ownership interests, shares of stock, at any time and without affecting the structure of the corporation or its operations. There are two primary disadvantages for the corporation in comparison to a sole proprietorship or partnership. The first is additional taxation, double taxation. We've discussed this, like I said, back in chapter 1, but remember, as a legal entity separate from its owners, a corporation pays income taxes on its earnings. Then, when it distributes earnings to stockholders in the form of dividends, the stockholders have to pay taxes a second time on corporate dividends that they receive. So the corporate income is taxed once on earnings at the corporate level and again on dividends at the individual level. A second disadvantage is the additional amount of paperwork required. To protect the rights of those who buy a corporation's stock or who lend money to a corporation, the federal and state governments impose extensive reporting requirements on a company. The additional paperwork is intended to ensure adequate disclosure of the information investors and creditors need.